You walk into a bank, you sign a few papers, and suddenly you have money. Not transferred, not moved from a vault, just there. Here's the uncomfortable truth most people never hear. When you take a loan, the bank does not give you existing money. It creates new money out of thin air. That sounds like a conspiracy. It isn't. It's how the system actually works. And once you see it, you can't unsee it. This matters right now because debt has quietly become the engine of modern life. Homes, cars, businesses, governments, they all run on loans, and loans run on newly created money. So if money is being created every time someone borrows, who's really in control? Let's slow this down. Most people imagine banks like warehouses. They think banks take deposits from savers, then lend that money to borrowers. That feels logical. It's also wrong. If that were true, banks could only lend what they already had. But banks lend far more than what sits in their vaults. So what's actually happening? Picture this. You apply for a mortgage, let's say $300,000. The bank approves you. At that exact moment, the bank does something very simple and very powerful. It types a number into your account. That's it. No pile of cash moves, no saver's account is drained. The money is created as a digital balance. On the bank's books, two things appear at the same time. An asset, your loan, you owe the bank $300,000. And a liability, your deposit, the bank owes you $300,000. Both are born together. This is not a loophole. It's not a trick. It's the core design of modern banking. Banks are not money lenders. They are money creators. Central banks openly admit this. Economists quietly agree on it. But most people never hear it explained plainly. Here's where it gets strange. That money you just received feels real. You can spend it. The seller accepts it. The economy treats it as money. Because it is money. But it only exists because you promised to pay it back. Debt comes first. Money comes second. Every dollar in circulation has a birth story, and most of those stories start with a loan. Now let's add one uncomfortable number. In most countries, over 90% of all money exists as bank-created credit. Not cash, not coins, digital promises tied to debt. That means when people stop borrowing, money stops being created. And when loans are repaid, money disappears. Literally disappears. When you pay back your loan, the bank deletes that deposit from existence. The money dies when the debt dies. Which leads to a quiet paradox. The system needs debt to function, but debt is supposed to be reduced. So what happens? More borrowing, bigger loans, longer timelines. This is why economies panic when credit slows. This is why recessions feel like suffocation, because money itself is shrinking. Now you might be thinking, what about central banks? Don't they control money? Yes, but not in the way most people think. Central banks don't create most money. They set the conditions for banks to do it. Interest rates, regulations, confidence. They influence how eager banks are to create new loans, but they don't decide who gets money. Banks do. This is where the power quietly concentrates. Banks choose which loans exist, which businesses grow, which assets inflate, which dreams are funded. They don't just allocate money, they decide where new money is born. And they prefer safety, which usually means real estate, large corporations, financial assets. Not innovation, not wages, not productivity. This is why housing prices explode while incomes crawl. This is why asset owners feel rich while workers feel stuck. New money flows where banks feel protected, not where society needs it most. Now let's address the irony. Banks create money, but they don't create the interest. When you borrow $300,000, the bank creates $300,000, but it expects more back. Where does that extra money come from? From someone else's debt. This means system-wide, there is always more debt than money available to repay it. The math only works if borrowing never stops. Which explains something people feel but rarely articulate: why growth is mandatory, why stagnation feels like failure, why slowing down feels dangerous. The system isn't broken. It's doing exactly what it was designed to do: expand. Now zoom out. Governments borrow, corporations borrow, households borrow. Debt stacks on debt. And as long as confidence holds, it works. Balances roll over, interest is serviced, money circulates. But when confidence cracks, banks stop lending, money creation freezes, and suddenly everyone is chasing a shrinking pool of money. That's when crises happen. Not because money vanished, but because it was never permanent to begin with. It was always conditional. So here's the quiet tension underneath modern life. Money feels solid, but it's temporary. It exists because of promises, and it disappears when those promises break. So next time someone says banks are just intermediaries, remember this: they are factories, and loans are their production line. The real question isn't who prints money, it's who decides when new money should exist and who gets to use it first. And once you see that, you start asking a much harder question. What happens to a society built entirely on money that only exists if we stay in debt forever?